James Rickards, Currency Wars, The Making of the Next Global Crisis. Embark on a riveting journey into the world of global financial conflicts and the potential perils they present in Currency Wars, The Making of the Next Global Crisis by James Rickards. This book summary delves into the intricacies of financial strain and the effects of currency devaluations on domestic and international economies. Explore global events through the lens of currency wars, including the Great Depression, recurring instances of currency manipulation, and the modern-day rivalry between the US dollar and the Chinese yuan. Prepare yourself for an eye-opening experience that will provide you with a clearer understanding of the tumultuous world of international finance.
The Financial War Simulation. The United States faces new threats from global actors such as jihadists, with perils including chemical, biological, and internet-based attack systems, as well as financial weapons that can undermine U.S. and global capital markets. To prepare for the possibility of a global economic battle, the Pentagon simulated a financial war game that marshaled Wall Street professionals, international policy experts, Department of Defense staff, and military personnel in late 2009. The simulation revealed that, in the event of a successful attack on the dollar, the U.S. owns enough gold to survive a fiscal war, underscoring the link between national wealth and national security. The ugly side of currency conflicts. Currency conflicts can lead to global financial crises and military conflicts. Currency devaluation to boost a nation's export can hurt trading partners and invite retaliation. The Great Depression in the 1930s was the result of currency battles that led to invasions and attacks. The world has witnessed collapses of the dollar and global fiscal meltdowns due to competing currency devaluations. China has faced allegations of gaining market share through currency manipulation. The consequences of currency conflicts can be disastrous, and it's essential to find diplomatic solutions to avoid them. The rise and fall of the gold standard. For centuries, gold served as a currency for international trade, but from 1870 to 1914, it became the anchor for the world's monetary system, the classical gold standard. This period is considered the first age of globalization, where productivity improved, inflation ceased, and society enjoyed better living standards. The gold standard stabilized international prices and created a system for adjusting trade deficits. Nations that followed the gold standard exchanged their paper money for gold at steady rates, and free market principles were respected. However, the period ended with the onset of World War I, leading to the first of three global currency wars that would play out over the 20th century and into the 21st. By providing insight into the history of the gold standard, this book illuminates the key role that monetary policies play in the progression of societies and economies. The Currency Wars and the Bretton Woods Pact. In the aftermath of World War I, Germany resorted to hyperinflation and devaluation to revive its economy, leading to a cycle of devaluations and economic turmoil that culminated in the Great Depression. The signing of the Tripartite Agreement in 1936 helped stabilize currencies, while the Bretton Woods Pact in 1944 tied the US dollar to the price of gold, ensuring economic stability until 1973. In the aftermath of World War I, the European nations faced enormous debts. Germany resorted to hyperinflation and devaluation as a means of reigniting its economy, sparking a cycle of currency devaluations across the world. The policy makers turned to the gold standard as a solution, but the situation only worsened. This resulted in financial disarray, leading to the Great Depression and the U.S. stock market crash of 1929. To restore economic order, the Tripartite Agreement was signed in 1936 by England, America, and France. This agreement was a significant step towards currency stabilization, ending the cycle of inflation, recession, and violence that stemmed from the currency wars. Finally, in 1944, the Bretton Woods Pact was signed, tying the US dollar to the price of gold and setting an ounce of gold at $35. This pact ensured economic stability, with a few minor recessions, until 1973. In the words of one expert, if the dollar falls, America's national security falls with it. The currency wars and the Bretton Woods Pact lay out an essential lesson that currency wars result in sequential bouts of inflation, recession, retaliation, and actual violence. The battle for currency. The global fight over currency began in 1967 when the U.S. federal budget stumbled due to the Vietnam War and social program spending. The resulting inflation caused the dollar to weaken against gold, and other currencies began to follow. France and Germany were among those openly criticizing the U.S.'s fiscal hierarchy. In 1971, President Nixon declared the U.S. dollar value would detach from the value of gold. Although this was met with opposition, the International Monetary Fund, IMF, and the G10 worked together to ease the trade deficit. The U.S. slid into a recession in 1973, leading to currency devaluations throughout Europe, and it took several measures, including hiking interest rates, to break the inflation spiral. The Second Currency War ended in the 1980s. The Global Currency War. The 2007 financial crisis sparked a currency clash between China, the US, and the European Union. Investment bankers, hedge fund operators, traders, and institutions such as the World Bank, the United Nations, and the IMF also entered the fray. The Chinese yuan and the US dollar are the largest players, but the stakes are higher, with potential consequences stretching beyond trade issues. The US dollar and the euro are interdependent, yet both nations want a solid euro. Pressure on the euro intensified with the 2010 European sovereign debt crisis. The dollar's decline. The almighty dollar's status as the world's reserve currency may be at risk. Russia, China, and other world powers are dropping it for trade and reserves. In 2008, Russia urged China to do the same, and Iran swapped gold for its reserves. In 2009, the UN called for a new reserve currency, while Brazil and China aimed to settle trade without the dollar. By 2010, Russia and China started a yuan-ruble currency settlement, and the World Bank pushed for gold to be a bigger part of global economic measures. Could the dollar be on its way out as the primary reserve currency?
The exploration of a currency wars makes it clear that the financial prosperity of the modern world is far from stable. Rickards' remarkable insight into the history and factors that can trigger currency wars emphasizes the crucial importance of maintaining a delicate balance between financial and political stability. As this comprehensive summary showcases, past and present currency conflicts have led to worldwide economic chaos, the collapse of markets, and even the outbreak of wars on numerous occasions. The significant takeaways from the book highlight the need for cautious navigation through these complex and uncertain times, awareness of possible pitfalls, and the importance of overcoming financial challenges to ensure a steady, prosperous future.